Yeah, Renan, just because something breaks through its ATR doesn't mean it's going to reverse, right? That's a whole different thing, but we'll talk about that. Maybe Thursday mentoring we can talk about that one. For now, hi everybody and welcome. Tonight and tonight's Tuesday session, we are going to be talking about how to trade utilizing Camarilla pivots. Camarilla pivots are for lack of a better concept, my where. It's how I isolate where I want to get in and where I want to get out of trades. So we are going to be chatting about that in some pretty extreme detail. And I'm going to try and I've done this webinar before. Obviously, I've written a book on this, a complete day trading system. Right. So I'm going to try and bring in maybe one or two things here just to kind of talk more about my history with the cams and maybe how they've come along to see if I can help everybody kind of tie things together. And we'll see how it goes. As I get started, generic disclaimer, read it, love it, hate it. Moving on. For anyone who is new tonight or has not seen one of my webinars, this is my 12th webinar this year. Actually, if you count the fact that I do 3 for Peak Capital as well, this is actually my 24th webinar this year. But if you also count the 3 I've done for Bookmap and the smattering of others I've done for a couple of other groups in between, I've actually probably done about 30 presentations on just stock trading alone this year, and that doesn't include my Thursday mentorings. I do one of those a week. So if you ever want to talk about getting lots of trading practice in and making sure you understand your trading material, become a moderator. It really helps get everything through. So I have been trading since 2018. I was fortunate enough to get to consistent profitability relatively quickly, but it has been in the past year or so that I've really hit my stride since developing and implementing my system, a complete day trading system, and going at that. It really works. I would say my main attribute that I'm really good at is actually volume and price analysis and reading the order book, but paired with pivots, I found to be an incredibly potent way to interact with the market. And I'm going to talk about the pivot side of that this time. Next webinar in January, I'll probably do a pretty heavy order book webinar, as well as I'm also going to be doing a webinar on kind of the pros and cons of using a funded trading versus using a prop or using your own account. So we're going to talk a lot about that. So in the introduction of the concept, I wanted to start off maybe by approaching this in a little bit of a different way. And I kind of wanted, before I actually went into the history of the cams, I wanted you to go into my history with the cams and kind of what got me interested in this. So, Wayne's World, right? I was really working hard to really move forward and really get to that really consistent profitability. And what I had found was I was really just not getting there, right? So you're talking about before I was even consistently profitable. So I'm really rewinding here, right? So you're talking 2019, right? Early 2019. We're getting about midway through 2019, and I hadn't really gotten things working. And I had tried quite a few momentum strategies and just really wasn't making progress. I would go through quick periods of, winning, but then I would go through long periods of prolonged drawdown, and just wasn't really getting anywhere. So I decided I needed to change things up. And my first hint that I got, and the first steer in the right direction, I got to give credit where it's due, is to a buddy of mine, Norm. If anyone remembers the moderator here, Norm, who was a very cornerstone guy in this community for quite a while, Norm G. Norm G says, "Hey, bud, you know what you need to do? You need to read. You need volume. You're not using volume. You need to start looking at volume and price analysis." And he recommended Anna Cooling, A Complete Guide to Volume and Price Analysis. Thank you. You know what I mean? And that kind of changed things a little bit for me. And this was before I'd even been to the NYSE, done any of that stuff, right? Exactly. Beyond me, Norm. And so as I went through VPA, I started getting a little bit exposed to market making and some of these broader concepts. and it really started to make sense. So I really liked it, and I went heavy into VPA. So now you're talking about another 3 or 4 months go by, right? 4 or 5 months go by. I had really practiced VPA. I'd been putting a lot of effort in on it, and I had become consistently profitable now using momentum strategies, ABCD patterns, reversals, head and shoulders and stuff. But I wasn't really making like a lot of money. Like I was consistently profitable now. I could kind of pick the right direction more often than not, right? But I still wasn't really making good money. So I decided I needed to start employing some range tactics, right? Because as I had looked around, a lot of the traders I was seeing really getting the good profit they were looking for. Traders even like Eamon were starting to use range tactics, right? Eamon was using parabolic reversals and stuff like that and holding for like 8-to-1s and 6-to-1s and stuff like that. But he would grab them off of the edges of, not the same kind of ranges I was using, but, key levels, stuff like that. So I kind of went through everything, and I really found a methodology that I really, really liked. And it was basically using previous day's high and previous day's low, right? And then I would use Fibonacci, and I was basically drawing a 20% retracement off the top and a 20% retracement off the bottom, right? And then I had identified that as a buying range, right? And then I identified the top as a selling range, right? Because if we were going to sell, we probably would sell from where we sold before. And if we were going to buy, we'd probably buy from before, right? And that is the architecture of this whole system, right? Over and over and over again until it doesn't. So this is what started to bring this system into focus, right? As I was waiting for it to get into the high of previous day, or the low of the previous day. And then I would look for a VPA signal, and then I would play. If that's where we bought from before, I would buy. And if we'd sell from, I would sell, right? And then if it broke through the selling range, I kind of naturally assumed that was another buying range. So I would buy, break out. If it broke down, I'd buy, sell breakdowns, right? And it really started to come into focus. But I was still kind of having a little trouble because not all the time, all of the action came off the highs. Sometimes it would make it like a third of the way, a little bit of the way. I didn't really know how to get further. And then this really nice guy, his name is Mark Douglas. Well, the real Mark Douglas, stand up. You guys see him in here every now and again. He shoots me, I think I was complaining during one of my afternoon sessions, because I think I was doing 1 o'clock to 2 o'clock at that time. And he says, dude, if you're liking that, you're going to love these. Right. And that's when I first got exposed to Camarilla pivots in general. Right. And I liked them so much because basically the same principle I was already using of selling previous high or buying previous high if it broke out, right? It kind of lined right up in the cams. Why? Because cams are calculated using previous day's high, previous day's low, and the previous day's close, right? High, low, and close. That's what calculates cams. And that's what really got me interested in them. Now, a little forward story here, and then we'll kind of get more into the presentation. Later, I would get to go to the NYSE, which I've been to probably, I wouldn't say a dozen times, but I'm definitely north of half a dozen. And I've gotten to do some really cool backstage stuff in there, and really got so. But now in hindsight, what I have learned is that Camarilla pivots specifically are one of the underlying structures, along with floor pivots, which are the classic pivot series and others, that the market makers really have been using within their quants for a very, very long time. And as we're trying to anticipate or think about the over and over and over again until it doesn't, right? The Camarilla pivots will end up being one of the best calculation methods for anticipating where those things should happen. So in the grand scheme of trading, right, every single trader needs to have 3 components, right? Where, when, and how, right? Your how is ATR, right? If you get into a position now, is there enough distance between here and where you think you can go for you to make money? If that answer is good, you're thinking about it, right? Then you need to look at your when, right? Are we going up or are we going down? Is there a VPA signal? Is there not a VPA signal? If there is, check, right? Then the where. Are we in the right place? If I go short here, right, Am I more likely to be able to buy later? If I go long here, sell later, am I in a range that is incentivized? Now, like I said, you could literally go and look at the previous day's low, mark previous day's low, do around a 20 to 30% retracement off of the bottom of that, and you're going to have your S3, more or less. I use my own calculations, right, that I've been slightly tweaked from some experience I've had on the NYSE, right? But, more or less, you really could do that. Mine just are automatically drawn for you, right? But you could just isolate the lows and highs of the days, do a little fib math, and you'd have where I was then, right? This system just adds a lot of nuance. And then what started to happen is as we pushed forward and I started testing and developing the system, we started coming up with the varied criteria in which we're going to look to play varied action. And that criteria was based on conversations I had had with key market makers that are currently active in the NYSE at this moment, right? So hey, Dwayne, so what we're going to be doing here is we just kind of rolled through the introduction. I want to talk to you a little bit about value, and then I'm going to tell you a little bit of history of actual cams, right? Then we're going to talk about the pivots. I'm going to show you really quick how to set them up in DOS if you haven't done so. I would show you a Ninja and TOS, but I just don't have time for that. TOS, for the record, we do have the new code out for TOS. It's in beta. And it actually, for those of you who have TOS, it actually, when you click on the chart, it actually tells you all of the range requirements, everything you need. And now the new version of that actually tells you which of these cam plays I'm going to show you is the appropriate cam play, or at least the preferred cam play to take based upon, these criteria, which is going to be pretty sweet. We have also started on development of those into Ninja. So I would expect early next year, hopefully within January, we should have a release of this for Ninja that will be available. I would love to do it in DOS. If DOS ever allows the architecture for doing this kind of coding, we certainly will put it into DOS very, very quickly. But we'll do it. But right now we just can't do it. All right. TradingView, I believe, may have the flexibility, and I'm willing. Right. I just don't use it, and I don't have anyone in my circle who does. But I'm certainly willing. I would love to get this coded for every single platform that's available, because my goal is to take all of what I'm going to show you here. I want you to understand it, know the purpose, and then I want you to be able to just see a key identifier on your screen, right, and be able to see, okay, this is the play I want. Now you don't need to worry about the where at all. Right. And that's the idea here is I'm trying to eliminate a lot of the effort you're going to put in mentally of analyzing charts, going through all the different things. I want you to know, based upon the information that's on the screen, where you should look for a particular type of action. That will free your analytical brain to actually focus on the price action itself, the stuff you're going to learn from Paris, book reading from me, tape reading from Paris, momentum reading from Andrew. Right now you can sit here and you can actually focus on these various things that I believe are very, very difficult, right? Instead of having to tax your brain with all of the how do I manage it and all of this stuff. We're going to give you that, or at least I'll be giving you all of that as much as I can. So this is what we're doing. So let's go. So the first thing we need to talk about, right, is the first thing we need to talk about is what is value, right? So the market that we are playing in wasn't a market that was made for us, right? It was a market that was made for large institutions and large investors to be able to exchange portions of their companies at a value, right? I mean, it's a really big deal if you think about it, right? When you buy a stock, even when you're retail trading, you're technically taking a little bit of ownership, right, in somebody else's company for a short period of time and then giving it right back, right? So, but if you think about it just by saying that concept, it really doesn't make sense, does it? You can kind of tell we're not really in our world. We're in our world. We're doing something within the market that maybe at first, innately, the market was not designed for. But because of Commissions, I think because of the desire of market makers to add additional liquidity and traffic into the market and some other things over time, retail has become viable and we've actually been able to come do things like this, right? But innately, all the stock market ever is at any point in time is a movement between one big order to another large order, and that movement being facilitated by an entity or entities known as market makers. Right? What a market maker carries inventory at all times, right? And is responsible for moving the stock price from large buyer to large seller. If anyone makes a request upon the market maker and that request is made with a market order, the market maker will instantly fulfill that order from their own inventory at whatever the appropriate spread is, right? But this does not mean that because you're selling, somebody else is buying, right? If no one else is interested in buying and you keep selling, the market maker just keeps accumulating and has no one else to give it to, right? For instance, if anyone is aware of what a low float is, one of the things people do not understand about low floats is what creates a low float and why is a low float a low float. A low float is a low float because the shares of that ticker are outstanding, right? They're not accounted for. They're not in somebody's account, right? They're not being held, right? They're in the ether, right? So if they're in the ether, who do you think off the top of your head would be able to hold a whole bunch of shares and not have to report them in as an investment or as something like that? Market makers, right? So one of the reasons why you have such a significant issue on tickers that get short squeezed, right, is because the market makers are the ones who are overly burdened, right? People have been selling, but nobody's been buying, no matter how low the price goes. So the market maker is just consistently and constantly being contractually forced to absorb price. Eventually, when the large request comes in, right, the market maker will be forced to move the price higher. And this is where all of these big roaring kitty gamma things came from, right? It was basically isolating tickets where the market makers were overburdened with inventory and then squeezing the price, right? Forcing the market maker through options chain exposure and other items to contractually move the price higher. Right? So this is the fundamentals of what moved the market, right? The market maker is actually holding shares and moving between large orders, right? But without the large orders, we don't move. Without volume, we don't move, right? We need the market to go up and find these. And this is all we do. This is our job. The hardest thing to do as a retail trader in this instance, right, is being aware and getting out and staying out of the way. One of the things we are going to do as a retail trader the most often, and it's so frustrating, and I'm going to show you a trade I took on the futures ES today, and I want to show you exactly how we set a high, exactly how I waited for the market makers to sweep that high, and then I got short right under R3 lower range for a movement all the way down almost to S4. Right? Why? Because the ATR certainly supported the ability to go that low, right? But it fit the strategy set absolutely lovely, but it'll just show you what they like to do and how they like to do it. So when we're talking about value, we're talking about ticks. We're talking about uptick, downtick, transactional volume. Wherever the most transactions occur, that is where we get value. Right? And that is what drives our principal concept of the Camarilla system, right? We're not talking about short term here. We're talking about long term, right? We're talking about the locations where buying and selling at institutional levels are going to be incentivized, right? And this is what the Camarilla pivots attempt to quantify, right? If we sold here before, if we bought here before, then we must have a seller here. We must have a buyer here. And now we're going to do the same thing over and over again based upon our closing positions until we don't. Open price highly influences. which expectation we have. Range width highly influences this, right? And where we are in relation to that range, whether it's higher or lower, has a lot to do with this, right? And that's what we're going to be covering here as we put this whole thing together. Now, Camarilla pivots themselves are actually not that old if you consider the stock market itself, right? The market itself has, it's been around for a bit, but the Camarillas themselves were actually only started originally calculated sometime in the late 80s to early 90s. There are people who his name is Nicholas Scott, who which I'll talk to you about in a second, actually took claim for these for a little while, and then we found out it was someone else. So Camarilla, right, is a Spanish word for cabal. I think it's an absolutely fantastic name for these things because, there is a cabal, right? I think a lot of folks, when we come in here and we start trading, we actually think, ha, 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 there's not a group of people making decisions that are controlling the entire movement of the entire stock market at all times. Or is there, right? What's the Fed do when he puts out his interest rate talks and all of these different things? Do you think he's raising and lowering interest rates because he's not manipulating the market? Who makes that decision for him? How's he getting that information? What's a beige book, right? What's a red book? All of these different, surveys of CEOs and in the know financial people, right? In order to make decisions by the Fed on where they should move rates, lower rates, change bond yields, all of these different things. That stuff's not dynamically happening in a capitalistic market. No. Those are all things that are being decided on by a very small group of people, right? Now, what is a small group of people who you don't really know all of their names and who they are, right, that do that? It's called a cabal, right? So I mean, Camarilla, right? So it was a really well chosen name. I wish I had chosen the name, but I didn't. The real gentleman was a brilliant student from Montreal named MB, was actually who discovered them in 1990 and who actually, or came out as the discoverer in 1990. Actually, there's word on the street, pun intended, that he was doing that more in like the late 80s. So I might have to update that. But basically the theory is that the price at most has a tendency to revert to its mean, right? So whenever you go into any kind of a market, price finds value, right? It goes to premium, it goes to discount, and then it finds value, right? So the Camarilla pivot system is a pivot system that's designed around the anticipation or the calculation of that process, right? What is premium? What is discount? And what is value? And when does premium become the new discount and go for new premium, right? And that's what we're trying to do here as we go over and over and over again until we don't. For anyone who's interested, these are my calculations that I use. These are the same ones that DOS uses. If you try and replicate these in a program or an algorithm, do not be surprised if they don't line up just right. You have to do a whole lot of tweaking with the time frames to get them perfect. And it's more than we can talk about in a webinar. But if that's something you're actually doing and you want help with it, let me know. I'll tell you everything I know on which time frames to use and how for which calculation methods. I have zero desire to hoard any of this information or proprietary whatever for myself. I kind of agree with Peter Tuchman on this one, which is the more everybody knows how this stuff should work, the better the environment itself will work, which will create better, easier, more fluid trades for everyone who's in the know. And I'm trying to get you all in the know. So if you just kind of keep an eye out, you know what I mean? We can roll with it. So this is, I just want to show you, this is an old chart from Roblox. I want you to see kind of what I mean by value, right? So when I'm just talking about finding, I'm just going to show you a couple of examples of some value areas, right? So you can see here, this right here is called VPOC, right? Or the volume pointer control. You can see over here we have the volume by price study, right? You can add this in DOS, really nice. And what it does is it shows you where all the so you can see there was a lot of transactions done here, right? And then there's a lot of transactions done here, right? See, these are our value areas. So, right, so you can notice this ended up being an R4 breakout on Roblox. You can see how we went up here and consolidated right on R4. But look where our value area is right here. So if you're going to buy and you want to buy, where do you think you want to buy? You want to buy right off of that value area, right? If it breaks that low and loses that right there, it'll probably leg down, right? But showing this large volume, holding here and then coming off of it shows, and look, anytime we sell hard, but our volume drops, you can tell pretty easily that we've got a floor set up here that we're consolidating on of R4 breakup off of it, nice and rolling. But you can see here how we can identify these value areas, right? Here's an example on DKNG of some actually some old school trades here I took for you. Just thought I'd roll this in here just so you can see. This one's from like May, I think. But you can see here as we were pushing up, we came up here. We had a volume spike. So I went short because of the volume. Stop was right there. I didn't quite get to my target, and it pulled back up, and I went ahead and cut that one, right? Because I didn't look at, this is when I was actually, this is before I was using 4-to-1s, all or nothings, huh? You can tell. So, and you can actually see why I started doing that. So when I went here, I went short. Right here, my stop was, knowing me, if I recall, my stop was here. So my 4-to-1 was right here. So notice what happened. I got short here. This was probably a little over 2-to-1 drop down. I took a partial, then I took another partial, and then I went all out. Wait, well, how much do you think I made on that? Not 4R, right? Because that partial came before 4R. That was a little ahead of 4R, and that was at 4R, right? So guess what? I made it to 4R, but I didn't make 4R. Story of my life before switching to 4-to-1s, by the way. Story of my life. Hitting 4-to-1s all the time, but only making like 3.5R, 2.5R, depending on how I partialed it, right? So anyway, value area. Look how it returned to value, right? Value tried to go away, right back to value. Big value area here. Value. Notice how we squeeze up. This is an old chart, right? NCLH back in the day. This is it kind of zoomed out a little bit. All right. So there's a general concept with the Camarilla system that you'll really, really like. Out of all of the complication, there is a very simple rule set, which is long above the 4s, short below the 4s, right? The reason why this is here is because I'm trying to keep you out of this guy right here, which is called the gray area, right? Ed Martin, Average Joe Trader, if you're familiar, he called it the kill zone. So basically, tickers, when they're transitioning from the buyer up to the large institutional seller, as they get closer to the seller, retailers and other institutional sellers will start selling, right? Because we're going from a buying range to a selling range, right? So we don't want to go long, even if it is a long, in certain ranges, because it will be too difficult to manage and stay in the trade, right? Have you ever gotten into a trade and although it went to your ticker, the trade constantly kept coming against you, constantly coming against you, constantly coming against you, and then it finally makes it? And you're like, well, the order book was really bullish. It looked like it had good volume. Why did it take so long? What likely happened there is you're probably trading long through the selling range, right? Even if you buy at S3, right? If you're doing an S3 to R3, as you're getting into R3, you're hitting a selling range, right? So this is why you don't want to buy away from S3 or in the middle of that range, right, in the CPR heading into R3, because right when you get to R3, it's going to waterfall off and come down and stop you out, right? So if you're too sensitive to those kind of things, which you should be, you need to make sure you're trading in the right direction. Think about the analogy that I think some of you have probably heard is a sailing analogy. I don't know if any of you have done sailing before, but there's a tactic called tacking, right? So when you're sailing, and the easiest way is to go from point A to point B, obviously, right? But you can go from point B to point A. You just have to tack or zigzag across the wind in order to get there. So when you're trading the gray area, you're tacking against your larger time frame, right? You're going into your larger time frame sellers, right? So as you go into it, right, it's it's going to push away from the price because you're going to hit sellers, which will waterfall the price, right? So you want to stay out of the gray area. So you want to get long in the appropriate range and try to do that. The Camarillas give you the gray areas very nicely, right? That's because we're long above the force and short below the force. So it basically kind of looks like this once you overlay your charts, right? If we're going to go long, right, we're only going to be going long from up here, right, or from here, right? And the reason why is because we want to make sure we're broken out from our selling range, right? Or we want to make sure that we buy low, and this is in a higher range, right? If we're in a lower range, we're actually not going to do that. We're actually going to short here, or long here, right? I have this all on a cheat sheet. I'll go through it all in a second, Nate. I'm just kind of giving you a little overview right now, a little taste, right? So the reason why is because as we're trading, we want to make sure we get a little bit of distance away from our stops, right, before we start running into the gray area. Because once we start running into here, what's going to happen is you're going to go long, it's going to get into here, and then the price is going to start falling against you as you crawl up to hit that final target before it either stalls out or reverses, right? So you want to make sure you get in here because that gets you that nice movement away from where you've entered. So when it comes against you, it doesn't freak you out, right? You're not having to hold through a full, which I do all the time. I know y'all have seen me do it. I hold through pullbacks. Like I had a NVIDIA trade, which I think I have in here to share actually, where my trade sold off, went all the way down, came all the way back through my break even, right? Or my what would be my break even if I used one, which I don't, went all the way up about a negative half R, right? And then sold and went and hit my target, right? So if I had been just a little bit closer to the price, right, I would have been out. You know what I mean? So being in the right position from the right area is real. You don't get your gray area. So this is, what did I have here? Oh, just another value. All right. It's the value area. All right. For those of you using cams and DOS, I will throw a PDF of this presentation when I'm done, so you don't need to screenshot. They'll be in there, but this is generically how they are done in DOS. Oh, you don't understand the gray area part. So let me hit that again. I've got time real quick. When we start to buy, we accumulate, right? And then we transition, and then we distribute, right? So when you start to accumulate and then you break out, right, your gray areas, right, would be trying to short down into the bottom of this because you're buying here, right? So you wouldn't want to short into buying, right? Anytime you're trying to go against the range is when you're in the gray area, right? So like if this is 3 and this is 4, right? So support 3 and support 4, right? You want to be this direction, right? Because you're in a buying range. If you're trying to short against the buying range, this is a gray area, right? Anywhere, if you're trying to go against that range, it's in a gray area, right? So when you go long here and you buy, right, you're going to transition. And as soon as you get right here, you're going to go into the selling range, right, which is where you expect to sell. If you're looking at Bookmap, you'll see orders there, right? You'll see orders to the bottom, your buying range. You'll see orders to the top range, bam, right? So as you get into the selling range and towards the selling range, right, then what happens as you start to get into the selling range is anyone who bought, especially retailers who bought in this area, will start selling here, right, which will cause the price to start running into sell orders, and the market maker will then start getting more sell requests on market, right, than buy requests. And even if the market maker is attempting to continue accumulating because of the additional sell requests coming in, this is going to cause the price to waterfall, right? So the market maker will stair step up, waterfall down, stair step up, waterfall down, even if they intend to break out. It doesn't matter. They're in a selling range. They actually need to buy through the selling range and then accumulate in the new buying range and then start a transition, right? This is where you'll have a VPA signal, an ignition signal, right? Because they'll reconsolidate, they'll reaccumulate at that new higher level, set the new discount, target new premium, ignite and go, right? So that establishes, this is why once you're above R4, you're no longer selling, right? You were in a gray area, you should, but now you've broken through the sellers and now you're in the buying range. You can start buying again because you're above R4, right? So what you don't want to do is be going long into the R's, and you don't want to be going short into the S's, right? If you're going short in the S's, right, to 4, you can go short after you lose S4, but until you get to S4, you're not. The 4s are our principal inflection points, right? Anywhere. So we're always long above the 4s, short below the 4s. And it doesn't matter what range you're in, higher range, lower range, wider range, narrower range. Nothing about that ever changes. You can literally in your brain just think at all times, long above the 4s, short below the 4s. And as long as you're doing that right, then you'll be trading in the right direction. But if you're like, for instance, if you're in the CPR and you're saying, oh, it looks like it's really bullish and it's in a higher range, so I want to play a trending breakout, right? Which there is a play for a trending breakout that opens, which I'll show you in a minute, that opens up inside the 3s. But in this play, we don't buy it till it gets outside of R4. The reason why is because if you get long on it, especially if it's in here, you're going to have to deal with it doing this all over the place until it finally breaks through, consolidates, and then runs, right? But the run and the really good move won't even happen till it does that. And I'm sure if any of you could put it in here, I think Microsoft did that this week. NVIDIA did that once this week already. Last week, I think Amazon did it. AMD did it on one day. They just chopped around like junk, broke above the R4 and then ran. One did it to the downside. So this is why it's important to wait for it to get into these right areas, because that helps us get those things. So I code my SMCI today. So I'll check that one out, Alabama, later. So you can see here, I code my R4 and my S3 green because those are technically my buying areas, although I do technically short R4. I actually did have a cam config where I actually had 2 charts overlaid, so it had like red on the bottom and green on the, it was cute. And then we're going to use our R3s or in our S4. This is going to be our shorting location. So I throw those red. So I'm going to have some terminology I'm going to dance around with here a little bit. So we have what's called inside days or outside days, right? Inside day or outside day is what we call them more now, narrow or wide, right? The reason I'm changing the vernacular here from the industry standard is because I'm trying to be more precise for everybody. And I don't want to just assume because our range is narrow that we're going to have a day where we go outside the cams. When we're talking about inside versus outside, what we're really talking about is where we expect to find value. As we talked about before, value, right? We're gonna go to premium, we're gonna go to discount, and then we're gonna find value. If value is found in the middle, large order in the middle, normally on a wider day, we're going to have what we call an inside day. So wide days are generically inside days. We're going to find value inside the range, right? So this is where most of our 3 to 3 setups are going to occur. S3 to R3, vice versa. S4 to R3 down to S4. Those kind of things set up better on the wider ranges, although they are appropriate on narrow ranges if the ATR fits, and we'll talk about that a little bit. So but we're going to expect to find value in the middle of the range, which is why we really call it an inside day. The value area will pass from day to day to day. The difference is the next day we end up with a tighter cam set because maybe we didn't move as much as we did the previous day. So we end up with tighter cams. So we're going to find our value area, which was likely the same value area from the previous day, but it's going to be found on the outside of the range. I find them both similarly. The ATR is actually the same no matter what kind of range it is, right? So I find both of them to be very similar and very easy to trade. It doesn't really have to do with more than just knowing where you expect to find that buyer or that seller at, where you're expecting to find value, right? If it's an outside day, you're going to probably find value closer to the 4s, right? Where on an inside day, you're going to find it within the CPR near the 3s. Right. That's what I did today. I did an R3 to S3 on the SPY today. But I did it on a future MES. But same thing. If you have pivots that have a very similar range or the exact same range, right, which is your S2 to R2, this is how we calculate some of our pivot ranges. If those are the exact same, then what I like to do is I default to the ATR. Right. So this is a new method that I'm just introducing in the past couple of months or a few months. Been talking about it for a while, but we've been kind of, moving some of these things into production. Right. So if you get a neutral range, what we do, and we do this for futures because futures always have a neutral range technically, is what we're going to do is we actually are going to look at the ATR. And if our range for our 4 to 4, so we calculate the distance between our 4s, and if our ATR exceeds that, then we're going to call it a narrow range because we'll have to exceed our range or go to an edge to find our ATR. If it's the reverse of that, where our ATR is engulfed by our 4 to 4s range, then we'll call the range wide, knowing that we would have to deviate ATR significantly to get outside of our range. Right? So for futures traders who are using the CAM systems on the futures, that's how we utilize those. So if you're calculating in DOS futures, I always use without. Right now, I'm basically always using without pre-market data. And that way it keeps them consistent and keeps them in line with rules. In TOS, I'm actually using my own futures calculation in TOS now, which pretty nice. So far, so good. And that calculation will be available in Ninja as well. So that's actually, so we're actually defining our own time frames in order to get those things to line up. So here's an example. I wanted to show you this particular example because if you'll notice the year, this goes back a bit. Right, or the date 5/20. Sorry, this doesn't show the year. This is from like 2000 and this is from what was it, like 21 or 22 or something like that. Like this is like a 3-year-old chart or something like that I had in my collection. So I just wanted to show you that these cams are not something that like I'm using now because there's some new hot thing. Like these have been used for decades. At this point, they're just not taught in momentum rooms. So there's just not a lot of exposure to the retail market on them. So you can see here on this day, we did a trending breakout. We opened inside the range here, and then went outside of R4, and then broke out on this day, and that was a narrow range. You can see this day we set up a wide range. Look, so you can do this in two ways. One is you can look at the 2 to 2s, and that's the easiest way. You can tell that the distance between the 2 to 2s here and there, this is wider. So you can call this wider. It is pretty easy. So you can see on this day, we actually opened and look, rallied right to R3, rejected R3. This was a higher range. So I would have wanted this trade to be at this, but because of the wide range, sometimes it hits R3, sold down here. And see what I mean by outside value or inside value? See what I mean? Our value area on this day is on the outside, where our value on this day is inside the range. Right? And so you can see on this day, right, we went and found new value outside the range. So, but this is an example of how you can see we're generically using the same large value area from day to day. You can see here we accepted value, went away, re-accepted it, and then we gapped and ran away from it. A couple days later, we actually came back, but I don't have that on here. All right. So higher range or lower ranges are how we kind of see if the ticker is looking stronger today or weaker today versus yesterday. Most tickers, after they close, or when we're calculating our cams, or previous day's high, previous day's low, and the close is how we calculate them. So there's two ways you can tell if the range is higher or lower. One way is just to use the CPR. So if you're looking at this is that 2 to 2 range again. If you're looking at your 2 to 2s and the 2s today are higher than they were yesterday, that's a higher range, showing some bullish intent, right? If they're lower, it's bearish. There are days when those things kind of interlap with each other, right? And that's what we call the neutral range. In the newer system, I get an update. I don't like the idea of having a neutral range. So what we do now is we actually look at what creates the cam ranges, which are the closes. And if yesterday's close is higher than 2 days ago's close, that is still a higher range. So the only way to really have a true neutral range, which has happened, Tesla did it a week ago. I think Apple did it 2 weeks ago, where we actually had the same exact high and low and the same exact close 2 days in a row. Think about when you're thinking about the manipulation of the market and how much control they have over the market and the market's movement. If you can think about that, think about a ticker being able to have the exact same high of day, the exact same low of day, and closing at the exact same price, a central pivot range. And the reason that happens is because the market maker is working one large client, or the market makers are working a large client. There's a large seller, there's a large buyer, and they keep closing at the same price every day for their distribution, right? You'll see at the end of the day on most tickers, the price closes, and then right after it closes, you'll see a big transaction. Pow! One big dot on a very, very narrow price, especially if you're looking at Bookmap. Right at the end of the day, up, down, up, down, up, down, up, down, close, pow, big order. That's because they spent that whole day getting that average for a client they already knew was there, right? But if that client wants enough shares that it's going to take a few days because of lower volume, then they'll literally hit the same high, the same low, close the same price, and hit that client. And they can do that a couple days in a row. So it is possible to have a neutral range. Now, if you have a neutral range, this means this particular market, right, Apple or whatever, is incredibly indecisive, right? They're in balance, they're at value, and they're working orders, right? Which means they're not likely to go anywhere. So in most instances, when you have a neutral range, probably better to stand off the ticker anyway. You really want a ticker that's moving, that has more potential, and waiting for a ticker that's been doing this, like, especially if it's a narrow neutral range for multiple days, better just to let it have a breakout day and then come and play it when it sets up the next day and play like the relief on it. So I have a couple of little cheat sheets in here that y'all can use to go through as you're looking at different things. So, and you can look at confirmation on where we open. And I'm going to get into my cheat sheet in a second, so it explains this a little bit better. So you're inside or you're outside and all that stuff. Once again, I like throwing in some random examples here. Wide range, inside day, consolidating at S3, and then a breakout the next day on R4. Right, that went out like crazy. Can anybody tell? This is called Facebook, not Meta. Just wanted to make sure you knew this stuff's been working for a while. You know what I mean? Been working for a while. You know what I mean? Just here it is again, R4 breakout, Facebook. What's Facebook? I don't even know. Here's my generic sheet that if you want to use it, you can. It just kind of has all of that laid out, the different confirmations that you can go through. I also have put this into kind of a cheat sheet or a checklist for you, so you can look at it. One of the things we didn't talk about is, and did I skip that? Making sure, depending on which cam set you're using, we have with pre-market or without pre-market data in DOS. And what this basically means is whether you're using the extended hours or the regular trading hours. The rule for that basically for this system is if you're looking at the previous day's highs and lows, if in the pre-market, if we've moved outside of that previous day's highs or lows, then we're going to want to use the pre-market data. So if any time in the extended trading hours, if we've moved outside of the regular trading hours' highs and lows, we want to be using that pre-market data because we want to see where the real value areas are. If it hasn't moved outside of those highs and lows, then there's really no reason to add it. So you don't need to. They'll be really similar. For futures, I just use only without right now. Although DOS uses with and without may still line up. But my, like I said, with TOS, I have a slightly custom calc, and it seems to be working really, really well. And I'll have that for you more. I'm going to share a new version of my TOS layout. Not today, but within the next couple of weeks once it's out of beta. It is so sweet. You're going to love it. But we're actually, like I said, it's going to call out. It has scripted in the preferred cam play that you should use, but I want to make sure they're right, and I want to run it for a couple of days. So this is my cheat sheet, which I think really lays out all of those. Now, if you're curious about all these plays and all these different things, don't forget I wrote a book, A Complete Day Trading System. And in this book, you can literally go through, and it has Chapter 1, Camarilla, Chapter 2, Pivot Relationships, Chapter 3, Pivot Strategies, right? So every single one of these strategies that I'm talking about here that I'm just kind of glossing through is detailed in excruciating detail. PDC versus 2PDC, higher range versus lower range. Whenever you're calculating ranges algorithmically, cams or any kind of pivots are being created off of the closes, whether they're higher or lower, right? So if you look at today's close and it's higher than or if you look at yesterday's close, and compare that to 2 days ago's close, right? And it's higher, we're in a higher range. If it's lower, we're in a lower range. It's really that simple algorithmically, right? So I did that to kind of, especially when we have neutral ranges or the cams are kind of hard to read because they're squishy, it makes it a lot easier. Yeah. So if you go through my book in excruciating detail, right, every single one of these plays are detailed. Now, again, I want to remind you, it is simpler than it looks, right? It's long above the fours, right? Short below the fours. And then in very specific instances, right, you can buy or sell the sixes, right, in the right instance, right? So they're all right here. Yeah, thank you, Dwayne. I appreciate that, buddy. So cheat sheet here. So I figured I'd take a minute and show y'all some trades. And then if y'all have any questions, I noticed there's a couple questions on the questions tab already. Maybe I can hit a couple of those. So no, just use the cams, Rich. Although I do swing trade using daily cams, and I can maybe do something more on that soon. Maybe I'll work on that for next little swigging with the cams. So I wanted to show you some examples of some cam trades taken based upon the system. What do you think is interesting about these two trades? They're on different days. Same ticker, different days. About 2 days apart, 2 or 3 days apart from each other. I mean, yeah, I feel pretty happy with it. But talk about the system working, right? Here we have on one day, hard sell right at the open, lower range, right? Lower range, both lower range tickers, right? So I'm looking for R4 reversals, right? So we opened, this 2 dots is 2 days ago's close. This 1 dot is 1 days ago's close, right? See, Abby, you can see here, really hard sell. Look at the weak volume. As we pull back up into R3, we then test R3 and start to sell. Short R3. Target 4R. Bam. Couple days later, and this is November the 14th. This is only a couple weeks ago, by the way. Opened, ran hard from R3, did not get my short because I was not quick enough. And I felt like I didn't feel like I wanted to go short here and stick my stop all the way above high. Felt a little wide, although I think it would have worked. So we pulled back. As we pulled back up, the volume declined a little bit on me, looked nice. So I went ahead short there, stuck it just a little bit above here, above the 50 mark. If it went up and broke and swept the high, I'd just let it sweep and then get back in. Target, boom. Google. The cam trade's so nice, I had to take it twice. Could have actually taken an R4 rejection on this one if I really wanted to, I suppose. But you can see here, we opened mid-range, higher range. We sold down into S3, held S3, so I bought the new high when we broke for our target hit. We then drew back down. When we drew down, we did so on pretty weak volume. So when we bottomed out, I went ahead and bought again, threw my stop below low of day. Right? Yeah, Rich. Threw my stop below low of day for our target. Doink. A little bit higher than the previous one because I use a fixed risk hotkey, right? So you can see it was a little bit higher because my entry was a little higher and my stop was a little bit the same. Just in case you're wondering. Very consistent. Uh-oh, same ticker. Here we go again. Here we have Tesla on a lower range day. We opened and sold under R3, so I went ahead and shorted R3, stuck my stop on this one above pre-market, above high of day, which was just above pre-market high. 4-to-1 target. And then on this day, we were in a higher range. We drew down to S3, bought off of S3. I actually missed this one because I was looking at a different ticker and but then it went to PDC, came off of PDC, and then did this beautiful wick to S3 and then came off of it. So I longed the new 1 minute high right there. 4-to-1 target, stop below S3. AMD short. Right? Big, really bullish engulfing, squeezed right into the, this one was actually a higher range, R4 extreme reversal. We opened inside the range, squeezed up to R4, tagged the high value area at R4. So when it stalled there, I shorted 4-to-1 target. Right? All the good stuff. And this is today. So for anyone who is, yep, trusted the cams, selling ranges and buying ranges. That's how I believe the market is that manipulated, that the cams will work even in high volume. Yep. But I'm waiting for the right selling area and the right type of volume. And when I got shorted, for the record, Dwayne, I want to remind you, when I shorted at the open there, I didn't short right at the open, right? I shorted like 45 or 50 seconds into the open, right? So as it squeezed up, I watched it sit there for 30 or 35 seconds while I was sitting there waiting for the stock to, and just watched it absorb on the tape. You know what I mean? So, and for me in the stock trading, 30 seconds to 35 seconds of watching a ticker is a straight eternity. You know what I mean? If I'm looking at a ticker for 35 or 45 seconds, watching it on a candle, I mean, I'm getting all the information. You know what I mean? So I could see that it bought up really, it squeezed really hard, really fast into a seller, and then just sat there spinning on the seller. And the order book had a void above it, right? So there was almost no chances it was going to go, right? So, and then the order book structure was down. Now on this one, right out of the gate, we had heavy selling right at the open, right? So it looked like we were going to distribute, but I wasn't close enough to R3 that if I threw my bracket would be above R3, right? So, oh yeah, I love stocks that that gap up and gap down, because most stocks that gap tend to move back to PDC, but I don't use like the gapper scanners or anything that's gapped really far or big. Milad, I actually generically trade the Mag 7 plus 1 or 2 almost every single day, SPY or Qs. My system is based on the generic over and over again of the market. And I like that because I have opportunities every single day to make money. The thing I don't like about trading gappers and high volatility tickers is when there's no gappers and no high volatility tickers, you're making stuff up. You know what I mean? You're out trading the same kind of strategies you would normally trade, but you don't have the gappers or the high volatility, right? No volume, no volatility, and no gap, but you're trying to play the same kind of tactics, right, that are on those, and that's why they tend to underperform. I don't trade those because the tactics I use underperform on those kind of tickers, right? So I tend to just look for tickers that are doing the same thing over and over and over again. And then I take advantage of more of the natural ebb and flow of the market rather than trying to chase the shining light, or whatever's in vogue that day. I'm gonna or whatever's memeing out. I'm just gonna go ahead and just hit whatever I'm hitting, which is great. I spend very little time every morning putting a watch list together because I'm basically don't. You know what I mean? So it really saves me a lot of time, so I can just focus on the tickers I know, what strategies I intend to employ upon them, and then just kind of waiting for those to set up. Much easier trading for me, at least doing that. So you can see here, we started off with a distribution pattern. You see heavy selling, and as we bought up, volume dropped. Heavy selling, as we bought up, the volume dropped. And then something, I want to show y'all something real quick. I'm going to just pull this up randomly. Give me 2 seconds. I want to show y'all something that the market has been doing like crazy lately. Let's see here. This is why I played this the way I did today. Or one of the reasons I played this the way I did today. Notice if you're watching, this is the NQ right now. I picked ES because ES had the clearer book for me today, and it had plenty of ATR, and it was cleaner within the ranges. I really liked ES today. But notice what happens almost every single day on these tickers. Watch this. Close, open, sweep, that gap, right? Sweep the top of it, sell, and then close. The next day we opened, swept that low, and then went up and closed. The next day we opened, swept that high, and then sold off and closed. The next day, because we had pre-market high was right, or pre-market low was right there, we opened, swept pre-market low, and then went into a rally. So one thing I've noticed is that the SPY and the Qs, because they've been more in chop, what they do is they'll set up and then they'll set the high, they'll sweep the high and then run. So I'm actually on these, I'm waiting for a sweep now because they do it so often. So here's the high, watch. Here's the high, right? They opened, distributed, came back up, set it lower. This is going to bring in more short sellers. They then bring it, squeezed it, pushed it up, and look, they swept through the high. Right? So I went short after they went up and swept and failed, setting that high for me, and I used a bracket order. So it just threw my stop right out here. Right? So this, so in order for me to get caught now, they would have to do a breakout, right? And they've already swept and failed to break out with good volume when they've done that. Right? So there's a lot. So this really looks good. So I went ahead and short there, stop there, and I use a bracket order. So here's my target. And that's what it looks like when it filled. So when you're thinking about this whole trading thing, just to kind of start wrapping up, the thing you need to think about is what I call TOAST, or the theory of all small things, right? When you're trying to put together a strategy or a system, right, the market is never going to give you every criteria you need, but you need to have some of the criteria from every one of the three major elements, or the trifecta of trading, right? You need a where, you need a when, you need how, right? Going back and thinking of it, remember, how is your ATR. If you're getting into a trade, is there enough distance reasonably to get to a target if you hold that trade, right? If that answer is a yes, move into the market structure. Does it look like we're a long, or does it look like we're a short? Are the market makers accumulating, or are the market makers distributing? These are all topics I've covered in other webinars that I will cover again in the near future, right? So, and we want to try and free up the how and the where, Andrew, right? So we can focus on the when, because it is the hardest part. Oddly enough, the hardest thing to figure out is just, is it going up or is it going down? Right? So we don't want to spend a lot of time working on all of these different things, and figuring out where to take a trade is incredibly difficult. And I want to remove that burden from you, right? So if you're following the Camaria pivot system, then you'll know where to look for trades. If you're using a basic risk management system like 4-to-1s, like I use with my profiting matrix, you'll know how you're going to take trades and manage them. So now you can turn all of your mental focus into making sure you've got a properly structured order book in the right kind of volume leading down that book, right? If you put all of those things together, right, that's what it really takes, right? You're never going to have them all, but you need to have the right area, you need to have the right ATR, and you need to have some indication that you're moving in the direction that you want to be moving in. If you can put those things together, then you'll be going good. A reminder to everybody, again, thank you. Do have the book out, is available in audiobook. And I really appreciate everybody for coming by and hanging out with me. Still managed to blow through 9:10 on this one. Somehow still ran long. I hope everyone had a great day. I appreciate everybody. And for anyone who wants to talk about this a little bit more, don't forget that every single Thursday night, I do a Thursday mentoring. So if you've got some questions, you want to talk more about these pivots, come on by, hang out with me and the other fun people at BBT, and we'll chat about some good things. I appreciate everybody. Thank you for spending your time with me. And as always, keep it green. Talk to you later.